we're going to cover the fundamentals of business finances. Everything from budgeting, accounting, forecasting, planning for tax season, everything you would need to know in order to run a successful business. Here at MTCS Business Finance, we've helped multiple small business owners clean their books, get profitable, and gain financial confidence. So whether you're just starting your business and or wanting to get more profitable, this video is for you. So let's go ahead and jump right in. So right off the bat, there's a huge and staggering statistic when it comes to businesses. Within the first few years, 82% of small businesses fail due to cash flow problems. So what that means is really business owners have a hard time understanding about money coming in, money going out, and how to best manage their finances to be able to support their business and to grow it. So by going through these things today, we're going to help set you up for success in your business. So the first thing we want to get into is some rules that you should follow. So number one, a basic rule that you should follow, and this is by the IRS, is that you need to keep separate your personal and your business accounts. So think about your business as a completely separate entity than you. You are an individual, your business is an entity. You want to keep everything separate. Why does that matter? Well, number one, you can pierce the corporate veil by allowing personal expenses on your business account. What does that mean? Well, piercing the corporate veil means that any legal protection that your business has pretty much is no longer valid if you get sued. So let's just take, for example, something happens in your personal life and you get taken to court. Well, now they can seize assets and things in your business because you allowed commingling of funds or paying things with your business that are really for personal. So we want to keep that protection and protect yourself from any legal or liabilities in the future that could come up. The second reason why is because if you don't separate it, you're going to have a headache come tax time. So if you have to have someone separate all of your personal and business expenses, that's hundreds and thousands of transactions that they're going to have to go through and figure out with you, okay, was this business? Is this personal? Where does it go? And that's just a headache you just want to avoid if you can. So by keeping it separate, it's really easy. This is what came in, this is what came out, and this is my business, and personal is separate. The other thing that happens here is that you lose financial clarity. So throughout the year, as you're doing your business, if you have business and personal mixed together, you have no idea if you're making a profit or a loss or where you stand from a financial standpoint. So what are the steps here? So one, you want to open up a separate business checking and savings account. And we'll get into this more, but a little tidbit here for when you're opening up accounts. If you know another business owner, what you could do is whatever bank they already bank with, see if they have some type of referral bonus. And if you can get, 200, sometimes even more, just referring, and you're going to open up a bank account anyways, ask your business friends to see if they can get you, hooked up with their bank and they get a little kickback for recommending you. For a savings account, I recommend a high yield savings account, but we're going to get into that more later when we talk about savings and emergency funds. So those are the two things there. And then we do want to start getting away from randomly pulling money out from the business and move to a salary instead. And this will happen over time. Maybe if you're starting as a side hustle and you're only making a few grand, all of your expenses kind of eat up all that and you can't pay yourself. But over time, you want to treat yourself almost like an employee. So you have payroll set up, your W-2, you get a salary. So we want to set this up because part of what you do is you're working inside your company as really an employee. The other half of what you are is really the investor or the stockholder. And we'll get into that separation a little bit more later. But yeah, you definitely want to start setting up a salary and paying yourself on a consistent basis as you continue to grow your company and your revenue. And then the last thing, you want to keep it separate. So if you have a business credit card you're going to use, again, don't put personal expenses on the business credit card. It just creates too much confusion. So whether you're doing a business credit card or a debit card, you just want to make sure you just keep things separate, above board, easy peasy. The next thing that we get into is a question I get asked when I start talking about salary is, how much do I pay myself? And so if you are a solopreneur, this is a really easy formula that you can do. So you're going to take your revenue or what you expect maybe for this year reasonably. You're going to take your expenses and you're going to subtract all those out. So all of your expenses to run your business. And then you're also going to want to subtract out your target profit number. So let's just say you're a service-based business that you look it up online and you realize that, for service-based businesses, they have anywhere between 20 to 30% profit margin. Then you want to bake that in. So anywhere between 20, 30%. And then what's left you could have as owner's pay. So that would be starting to take your salary. So just to give a quick example, let's say you make $100,000 for the year. And then your expenses for the year are $30,000. And then your target profit, let's just say, is 20%. So you minus another 20K. And so then your owner's pay for the year, you could set it at $50,000 based off these assumptions. So if you end up doing a little less, a little bit more, you might need to adjust this with your whoever's doing your payroll, and or you can just do it yourself if you want to set up your own payroll. There's softwares like ADP or Gusto, to where it's super easy to set up, and then you could start paying yourself a salary. And so that's everything here to figure out how much you want to pay yourself in your business when you're just starting out. And so what this will look like over time as owner's pay, in that example, that was about 50% of revenue, because we took out all of our expenses, we took out our target profit, so we have that money left over as profits, and we'll talk about what we do with those profits later. But the owner's pay was about 50%. And when you start your business, that's pretty typical. Anywhere between 30 to 50% of revenue you can, pretty much set aside as your salary. But what happens as your revenue increases in your business, the percent of revenue that you're paying yourself actually declines over time. A good rule of thumb is around 10%. So, if you make $1 million, then, you might be doing 100K salary, and 2 million, 200K salary. And then you can go into adding in like your part as a shareholder or the owner of the company, which is a distribution later on from the profits that you make. So that's just an easy way to think about it. As you continue to go up in revenue, the amount that you're paying yourself will go down, and it should be correlated to the roles that you're doing inside the company. So if you're wearing multiple hats, this may be a little hard in the beginning. So what you really got to do is figure out what's like the fair market value for what I'm doing inside the business. And if you're wearing multiple hats, I'm not going to lie, this is going to be really hard. So that's why I say, do it as a percent of revenue, and then based off what the company can afford. And then when you get to a certain point, you're going to want to do it, maybe stick to a 10% of revenue, or just base it to your cost of living. So your salary is guaranteed every single month. It'll cover your cost of living. And then if you have anything extra in profits, you can take that later to add pretty much a cherry on top, like a bonus for yourself. So that's the way I would think about paying yourself as the owner. The next thing that we want to do, rules to follow, is we want to, pay what's owed on time. So as a business owner, you don't want to be that business owner who people keep on calling you up and say, hey, are you going to pay me? This week, next week, it was supposed to be due, a month ago. So, if you start falling behind on taxes, payrolls, vendors, you name it, those are definitely warning signs, right? And again, no one really wants to be following up with other business owners to ask them to pay their bills. So again, just don't be that person. Avoid it. Always make sure before you take on a new employee, a new team member, before you work with a new vendor, make sure you actually have the profits and the cushion in your budget to then add them on without actually having to, run into the negative, or now you're at break even, or, right on the edge. So you always want to make sure you have room to bring on those people. So how do we do this? So we're going to set aside 30% of our profits for taxes to make sure that that's good each and every quarter or year, depending on how much you're making. 2, you want to make sure you automate as much as possible. So if you can automate payroll, like I was telling you with ADP, Gusto, there's a lot of different services that'll do that for you. So you just set it up one time and then it just runs. And then any type of bills that you have, you can set up payments through your bank account. Sometimes the accounting softwares you use, depending on which one it is, could have automatic payments of bills. And then there's also standalone softwares that just handle bills that you owe. So a lot of ways you can do it. And then if you are going to stick with a manual process in the beginning, just make sure to review your payables or what you owe to others at least once a week to make sure nothing falls through the cracks. Again, don't be that person who doesn't pay their bills. All right, so now that you understand those 2 simple rules, we're gonna get into the 4 profit principles that can apply to you whether you're just starting your business or if you've been in the game of business for 10, 20, 30 years. So the first one is prioritize clarity in alignment, which really means you gotta know your numbers. If you don't know your numbers, how are you knowing if what you're doing is making more money, less money, if you're breaking even, if you know, can I pay this bills? Can I take on this team member? You can't answer any of those questions if you don't know your numbers and they're not very clear to you. So we always want to prioritize clarity in alignment as a foundational principle of running a business and having profits in your business. So it should never be a mystery, right? And then you need to start reviewing these 3 reports. So I'm going to go into each one in slight detail. I'm not going to give you everything. So In future videos, I will make larger breakdowns of each one of these statements. So make sure you subscribe to this channel, and I'm going to do it, go full blown. But in this one, I'm just trying to teach you the basic principles here. So we have a profit and loss that pretty much tells you what you earned versus what you spent to get that money. So think about it this way. If you earn $1 of revenue, or you get $1 of revenue in, how many cents did it take for you in expenses to get that $1 of revenue? The lower the amount of cents that you spend is the more efficient you are at generating revenue. And the difference between those two numbers is typically called profit. So the balance sheet is the second big statement that you look at, and it's going to tell you what your business owns and what you owe others. So owns, think of assets, and again, we'll get into this, and then owe others, that could be debts, credit cards, things like that. And then the cash flow statement really just tells you what change in your cash position happened over a period of time. So if you look at the month of January, for example, and you want to know where was my cash at the beginning of the month and what happened by the end of the month. And so most business owners, if they're not keeping track of their profit and loss or balance sheet, they are keeping track of what's in the bank account on a daily or weekly basis. So it's very similar to that, but it's just helping you understand, are we in a better cash position or a worse cash position, and why? Hey, and by the way, if you want more tactical advice on how to increase your revenue or decrease your expenses in your business, go ahead and sign up for the Financial Focus newsletter. That's a newsletter where I write each and every week to small business owners, and I give them practical advice on how to increase the profits of their business. So if making more money and saving more money sounds interesting to you, click the link below and sign up for the Financial Focus newsletter. I told you I'd jump into this a little bit. So profit and loss, really the main things here are money coming in, revenue, through your operations of your business. And then you have your expenses, so the cost to generate that revenue. So a couple numbers here that you want to start looking at if you're just starting. So you have revenue, so that's number one. Look at revenue. Number two that you want to look at, I would suggest, is your gross profit. And really what your gross profit is it's revenue minus the cost to fulfill on that service or that product. So let's take, for example, this pen. Let's say you don't manufacture it, but you just buy it from someone who's built this pen already, and you're just pretty much selling it to someone. So when someone clicks. So when someone clicks buy on your website, then you've paid already for this. So there's an inventory cost, let's say it's $10. And then there's a shipping cost to their door. And then there may be any taxes or fees, whatever associated with that. All those things to get it from inventory to the person's door in this example would be a cost of goods sold. And so you want to make sure you're keeping that in check. And then you'll see that what's remaining after those costs is called your gross profit. If you're a service-based business and you provide services to other businesses, for example, the cost of labor is your cost of goods sold in this case. So if the person costs you $50 an hour and it takes 10 hours for them to provide that service on a monthly basis, and you're able to charge $2,000 of revenue minus the $500, that'll get you $1,500 in gross profits. So hopefully that makes sense. So that's the second big number that you want to look at. The third one is net income. And this just means what's left over after it's all said and done. So this one you'll hear is profit. Sometimes you'll hear is net income. At the end of the day, it's literally how much money is left over. And this is what ends up, becoming your taxable amount at the end of the year. So for a full calendar year, typically, they'll look at it and say, got it. If you made a profit, this is how much you're going to owe in taxes. So those are the three numbers: revenue, gross profit, net income, that I would start looking at to get a better understanding of your profitability of your company if you're not already tracking it. The second one is the balance sheet. So you have assets, liabilities, and shareholders' equity. So assets, again, are the things that you own or, equivalent to that. So think cash. In the example of the pens, if you bought inventory, that would be here as an asset. If people owe you money, so let's say that you provide a service and then I say, hey, you owe me within 30 days of completing the project for you. Well, then that's called accounts receivable, or AR for short. And so that's an IOU from the customer to you. So that's almost treated just like cash in business. And so that would be considered an asset. You can also consider, land, like a building a car, equipment, things like that would be here under assets. And then on this side, you have what you owe. So any debt is really your liabilities. So things that you would owe other businesses or credit card companies or banks, like in loans, anything there would be considered a liability in general, right? There's more to it, but I'm giving you the basics. So if you have your assets over on one side, minus all the debts that you owe, then what's left is your shareholder equity, which is really considered by most your net worth. So ideally over time, you want your shareholder equity to continue to rise in value, your liabilities to go down in value, and your assets to rise in value. So that is the mark of a healthy company, because that means you're lowering the amount of debts that you owe, which means you're reducing your risk. You're bringing up shareholders' equity, which means you're improving the value of the company, and then you have more assets. So if you ever were to sell it, you can turn that into cash. So it's cash or cash equivalents that are there to help you make money for your business. So the next thing we look at is this statement of cash flows. And this statement, again, just tells you where was your cash at the beginning of a period and then at the end of a period. So if we took January, for example, it's going to tell you, okay, on January 1st, you had this much money, and then here's all these change in cash that happened across the different areas of your business, between your working capital, meaning inside your business operations on the day-to-day, between buying assets and selling assets, and between financing, so taking on debt, removing debt. And then at the end, you're going to have an end of cash period position. And so that's all it really does. Again, if you're monitoring your bank account, it's very similar to this. So those are your three. The second profit principle that we need to know is spend less than you make, i.e. be resourceful. So typically, you're going to get these really big breakthroughs when you don't have, all the money in the world. You're forced to find alternative ways to then still be productive or still make the deadline or become more efficient at what you do. And so debt is one way it could be a trap, because then that's easy money available to you to kind of solve your problems rather than dealing with what you already have on hand and just being resourceful with the dollars that you do already have from just your normal business operation. So the most financially stable businesses actually grow from their profits and from their cash reserves. And we're going to talk about this more. I have a good illustration for this, but that's where we want to get to. We don't want to dip into debt if possible. And so how do we start building cash reserves? So one, we want to get profitable if not already. And if you're struggling with profitability, I've made a lot of videos on this channel about profitability, so go check them out. I'll go ahead and link a few up here for you to check out as well. Number two, you're going to start saving 15 to 20% of your profits until you have 1 to 12 months of expenses in cash. So let's say for a year, you have $100,000 in expenses. So then at a minimum, you want $100,000 in cash saved. At a maximum, you're probably going to want 1.2 million cash saved. Now, the key is to find the right point for you and your business, your industry. If you're a less risky business, meaning if it's good times or bad times in the economy, the people are still going to pay you. If there's COVID lockdowns, people are going to still pay you. If there's whatever else is going on in the world, people will still pay you, right? That's the ones that are the least risky businesses. And so you don't need that much cash on hand because it's guaranteed that you're going to get paid. On the other end is the most riskiest businesses, and you want to save as much as possible. The reason why you want to know exactly what it is for you is because if you keep too much cash on hand, then it's going to be eaten away or eroded due to inflation and those pressures. So you don't want to keep too much cash on hand, but you don't want to have no cash on hand, right? You want to build that reserve, but just not overdo it. So most businesses end up falling into 3 to 6 months. So again, back to that example, you would need around $300,000 to $600,000 in cash saved. You want to do any big purchases in cash. So no financing, furniture, cars, software, anything like that. And you want to delay until you have the cash. And then don't let the loans force your timeline. So in most instances, you're going to want to run a profitable business, and then you're going to have this money saved up that you can then deploy into those growth opportunities, projects, new equipment, those things. And you use that to expand your operations. So again, this is the way I see how a company can run. Most of the times, or majority, you want to stay right here, meaning your business has profits and you're using that to grow your company, nothing else, right? You have the profits that get reinvested, bam, you're good to go. Sometimes if it's a big purchase that you're doing, you might have to dip into cash here. But if you're dipping into cash just to fund your normal operations, meaning you're not running a profitable business, one, and two, you're starting to hit your cash reserves, that's going to be a sign of there might be a problem with your pricing or your efficiency on how much you're spending to make a dollar, or maybe your acquisition channel, whatever it may be. Then we get into the next one, which is debt, which for most businesses is the danger zone. So if you are taking on debt to fund your normal operations, so think credit cards, line of credit, SBA loans, things like that, then you are definitely in the danger zone. So you want to get out of that as soon as possible to get back up again into profitability and then build up that cash reserves so you have more insulation from that and game over, which means you have to shut down your business, right? 82%, again, that stat, 82% of businesses fail because of cash flow issues because they go down this road and they can never get back up to being back into the cash and the profits area. So if you're using debt to fund your business right now, be very, very careful and say, how can we get out of this position and back into profitability? Usually when I work with clients, I give them 30 days. You have 30 days to get back to profitability. I don't care if you grow out of the debt, and I don't care if you cut expenses to get out of the debt, but usually it's a combo of both, and you got to get out of there in 30 days. Because most business owners are very optimistic and think, oh, well, next month it'll happen. Next month I'll grow out of it. Next month I'll grow out of it. And then 6 months go by, a year goes by, and then now they're in more debt than they were a year prior. So you got to make the hard decisions. You got to make those cuts in order to get back into profitability. So bonus tip here. All right, so if you find yourself in the debt zone or in the danger zone, what you could do is if you have, the credit score available and you haven't tapped all of your credit, you can open up a new credit card and you can help free up cash without having to pay interest. So if you do have debt already and you're already paying interest on it, we'll try to offload some of that if it's recurring costs to a new credit card that doesn't have any interest. Usually on an intro, there's 12 to 18 months where you get zero interest. And so if you can offset that and then take that cash and pay down the debt that does have interest, well, that will save you money and hopefully get you out of that debt cycle quicker. So that's just a bonus there for you if you found yourself in that situation. The third profit principle is think like an investor. Simply put, you have to have a return on investment for every dollar that you're spending. So think about time savings, think about revenue generation. Those are the concepts that you want in your mind around, is this dollar best spent here? Because in business, you're going to have unlimited opportunities, but limited dollars typically. So you got to find the things that are going to give you the best ROI. Either they're going to give you the best savings for your time and free up people, and then it'll hopefully generate more revenue, or I'm going to invest into this person because that's the best thing I can do to then grow my company. So you got to figure out what are the top priorities, what are the ones that are going to give you the highest ROI, and focus on those things. So the key concept here is the business is the asset you are growing. So most people will say, hey, you want to save 15, 20%, put it into your 401k, put it into your Roth IRA, whatever it may be, put it into stocks, put it into bonds, and then allow it to compound over time, and you're going to have a really good retirement. You are doing that same thing. It's just not in real estate, it's not in crypto, it's not in stocks, it's not in bonds. It's in your business. You are building a sellable asset in your business. So not only are you going to be taking a salary, but one day if it continues to grow, you're going to be able to sell it for a lot of money or bring on a team and let it cash flow. Then you can go, do whatever you want for your retirement. But the point is that is your asset you are building. So you want to put as many dollars back into that as possible. So just because you can afford something doesn't mean you should buy it. So again, always look at everything through an ROI standpoint and say, is this going to get my company bigger? It's going to grow to the next level. And then again, one day either sell it or be able to get the cash flow coming from it. So again, if it doesn't generate revenue or improve efficiency, just leave it alone. And even out of the options that are there, pick the top ones. Don't pick all of them. Okay. And then one big thing too, ignore the spend to save on taxes myth. So again, when you are spending money, ideally, right? Let's say you're running ads. If you spend $1,000 and you get $10,000 back in revenue and $3,000 back in profit after all the costs have come out, that's a printing machine. You're getting 10 to 1 on revenue and you're getting 3 to 1 on profit. So if I put in $10,000, I would get $30,000 in profit. That's a huge number. But if you're using that money instead to I want to lower my tax bill, well, you're putting in $10,000, $20,000, $30,000 maybe to buy a car. one that's not going to help you get more clients, not going to increase the revenue, not going to decrease the time or have any savings efficiencies there. So one, it already blows out there's no ROI on that. And then the only savings you're going to get is on your tax bill. And your tax bill, you might save 20% or 20 cents on the dollar, 30 cents on the dollar, 40 cents on the dollar. It doesn't make any sense to do that when you can spend 1,000, get 3,000 back in profit in a acquisition channel. So you got to figure out where your best return on investments are. And again, focus on those. Don't worry about the 10 cents, 20 cents, 30 cents. You're in business. There are better opportunities. There are more advantages that you have once you have a reliable business to increase your value, increase your net worth, increase the asset that you're growing, which is the business, than to save a few cents, in this case, on taxes. So again, and then another just thing to keep in mind here is you want to keep your overhead low. You don't want it to get out of hand, meaning your payroll is typically your biggest expense. So when you're looking at this, you want to try to put in some type of cap to your salary. So you never go above that and spend more and you start losing your margins, your profitabilities. So typically it's somewhere between 30% to 40% of revenue. So again, if you made $100,000, you don't want to spend more than $30,000 to $40,000 in total payroll. So that's benefits, that's taxes, that's paid time off, that's anything else, including their salary, all baked into that, okay? And obviously, if you get to $1 million in revenue, you just times it, do the same thing. So that's just a general rule that you can follow. You can get more specific as your business grows and dial it into your specific industry. But if we're talking just general rules of thumb, that's a great one for you. So again, talking about compound interest. I think I already hit this point already, but compound interest is the eighth wonder of the world. And if you want to escape the rat race, if you want to be able to have financial freedom in your life, you need to leverage this compounding asset, which is your business, which to me is the fastest way to generate wealth. If you look at all the wealthiest people, most of them are business owners or they deploy other people's money, one of the two. So you're either an investor or you're a business owner. That's pretty much it up at the top. Okay. So the fourth profit principle is thinking long-term. So meaning we want to optimize for sustainability. We don't want to just do short-term wins. It's what's going to grow our business in the long term over the short term. So again, resilience comes from proactive planning. So you got to know, how are we going to be more resilient this year than we were last year? How can we grow and focus on things that are going to make us even more resilient moving into the upcoming years? So we want to focus here on forecasting, budgeting, setting aside reserves, and being prepared for opportunities and challenges. Now, I remember when the 2008 financial crisis or a housing market crisis hit, the people who made out the best were the ones who had cash sitting on the side that could buy, the real estate. Well, it's the same thing in business. There's more opportunities that come when everyone's freaking out and there's recession than when it's the good times and everyone's, just spending money. So you want to prepare for those opportunities and or challenges. Like you may be a seasonal business, you may be affected by downturns yourself, and you want to have that cash position there to help insulate you from dipping into debt. Again, economic downturns, capitalize on opportunities. We want to build the financial health, support, again, the wealth, the freedom, and we want to be able to create stability. So whenever you bring on new team members, you don't want to have to cut them, a month, 2 months down the line because things took a downturn. We want to be able to support them and grow steadily but securely. We want to be building a solid foundation from a financial standpoint in the business so that every move we make builds on top of each other and builds a structure that is strong and can last for a long time. And one more bonus profit principle that we hear about MTCS is we want to balance people, purpose, and profit. Because if you just optimize for profit in your business, guess what? People aren't going to want to work for you because you're not paying very well, one. And two, you're going to probably, most likely, stray away from your purpose or the reason why you started your business in the first place. And so we want to make sure we're balancing all three of those things when we are building a business that is built to last. And so what does that look like, right? We want to invest in our team. So bonuses, benefits, training. We want to invest in our customers by discounts, giving even more value and providing gifts maybe during the holiday times. Or it could be to your community, like around you, that you could support some local businesses or nonprofits, things like that. And then you also, again, you want to be building a brand that stands for something. It's not just at the end of the day, how much money can I get, but it's how can I leave the world better than I found it? So those are some things to think on. Again, that's a bonus one. It doesn't necessarily have to apply to you if you don't want it to, but that's one that we teach to our businesses that we work with, and we want to encourage business owners to do more. So let's go into the 4 practical things that you can do to help your business. And the first one is making and following a budget. So when you say budget, or when people say budget, usually people get a negative connotation. They're, oh my gosh, I don't want to have to deal with this. But it helps you make a plan and put order to your dollars. It gives them somewhere to go, something to do. If not, then it's just going to be haphazard and it can go anywhere. So we want to create discipline and structure around where our expenses and where our spending is going. So it's about restriction and it's about planning for growth. It's about both those things, because left unchecked, then expenses go wild. If there's no cap, like we talked about earlier, like a salary cap, then salary expenses will just keep on rising as you get bigger naturally. And so you also want to make sure you're planning for growth. So as you're growing your business, you're like, okay, I know, if we take on 10 more clients, we're going to need more people to help service those clients and more customer support to answer phone calls. So you got to understand, like, as you grow your business, what are the natural next things you're going to need for that level of growth that you're handling. And so what you want to do to start a budget, right? We're going to keep it really simple here, is you want to look at your last month's numbers and look at your revenue for that month and say, okay, this is the month how much came in. And then you want to list all of your expenses, typically the bigger ones. So you don't want to list out every single line item, just make a number, just set it to like 500 or 1,000. So if it's under that dollar amount, then just roll it up. So if you have, business administrative costs, and then you have like, oh, I sent out mail, and oh, I, did these 2-3 other things, and they're like little numbers, just roll it up to a higher category. Okay. And so you're going to list out all your business expenses for the month. And then you're going to see, okay, got it. This is what this looks like. And then you want to forecast for the next month and say, okay, I think I'm going to get this much in revenue. I think these are going to be all my expenses, and see what happens. Did you hit those numbers? Did they not hit those numbers? If you were off, why were you off? Make adjustments, try it again. Once you have 1 month down, then you want to try to go to about 3 to 6 months. So you can say, okay, I know for the next 6 months, this is probably how much I'm going to bring in revenue. This is how much my cost. This is how much is going to be my profit. And then you can start, figuring out what you want to do with that profit. But the first part is you have to make a budget so that you can plan for those expenses, and then, move the money where it needs to be, or best served for the company to grow. Number 2, you want to do your own accounting. So in the beginning, I would really suggest you do your own books so you can get a basic understanding of finances. Because if you want to read your 3 statements, P&L, your balance sheet, and your statement of cash flows, it starts with understanding what makes up those numbers. And that's doing your accounting, doing your books. And there's 2 methods around doing your books, which is cash and accrual accounting. For most businesses, I would recommend you just doing cash accounting. It's just so simpler, easier from a logical and thought process standpoint to be able to put things into the accounting software. So that's what I recommend. It's more intuitive. So cash accounting records income when the money moves. So when you receive money from a client, that is revenue. When the money leaves the bank to pay an expense, that is when the expense occurs. Just that simple. Accrual accounting is when the transactions are earned or incurred, even though the money hasn't moved. And so that sounds very technical. I'm going to give you an example to make this super simple for you. But the only rule requirement here is if you're an inventory-based business, you have to do it. If you're just starting, you have to do accrual accounting. But for most, like I said, stick with cash accounting. It's just way simpler, super intuitive, a lot more user-friendly, right? So an example. Let's just say you sell tickets, like you sell tickets to shows, and you're selling tickets for a show that's in January, but it's December right now. So you sold a ticket for $100 to someone. They gave you the money after all the other fees and all that good stuff. And you have $100 in the bank. You just received it. If you were doing cash accounting, then you would receive the revenue, or you would count the revenue in December, because that's when you receive the money to your bank. You see how intuitive that is? But in accrual accounting, that's not how it works. It doesn't matter when you receive the money. It matters when, in this case, the event occurs, or when the transaction actually happens. So they pay money to go to an event. So when the event actually happens is when that revenue is recognized. So in accrual, the revenue would be in Jan in this example. So for most businesses, again, cash accounting is going to be your best friend because it's just way simpler to understand. Now, if you sell things way far in advance, like let's say retreats or events like I was just showing in this example, then accrual may be better because you're receiving the cash at one point, but then recognizing revenue. And so when you think about taxes, it's all about when you recognize revenue. So if you receive the money, midway through the year, June, July, but then, you're selling a event that happens in January, do you want to pay for taxes in the year prior or the next year? Typically that year that you actually did it, because you want to kind of delay it as long as possible to pay those taxes if possible and hold on to the cash. So that would be an example of when you'd want to actually do accrual over cash accounting. But for like 99% of businesses, cash accounting is your way to go. Now, one other note here. If you're doing more than 25 million over the previous 3 years in gross revenue, then you have to do accrual accounting as well. So if you get big enough, then it's only accrual as your only option. Now, you can keep a side-by-side cash accounting record as well, and some businesses do that, but you'd have to, for tax reporting purposes, start using accrual accounting. Okay, so the next thing you need to do is you need to start saving. If you don't have a savings yet or plan for savings, this is how you're going to implement this in your business. Okay, so we want to create that financial cushion for you. So the first thing we're going to do here is open a high yield savings account because we want to collect some interest on the money that's just sitting there. That's a win, right? We're not doing anything, we're getting paid interest. That's a great revenue source in my book. So you're going to open up the high yield savings account. And if you're debt free, you're going to save 35% of your profits into the savings account each month until you hit your savings goal. So remember that 1 to 12 months we talked about earlier. Well, you're going to pick yours. So maybe you pick 3 months and you do $10,000 in expenses. So you're going to try to save up to $30,000 cash. And again, this is going to be in a separate account, even separate from big purchases. So this savings account is only for emergency use only. Like there's a sticker on there that says emergency use only, right? And it's separate from when you're going to use for big purchases. And you don't want to, again, drain your savings for a new laptop, a new car, anything like that. So what does this look like? So if you don't have debt and you have profits, right? Revenue comes in, expenses go out, you have a profit left over. Then what you want to do is you want to put 35% of that into a savings account. So think of your profit, and let's just say you do this every quarter. You can do this every month, quarter, half a year, whatever interval you find most useful. Most people will either do a month or every quarter. So let's just say every quarter you look at it and you say, oh great, I made $10,000 in profit this quarter. Well, then 3,500 would go to savings, 3,000 would be set aside in a tax account if you have to pay quarterly taxes or annual taxes. And then 35% would be in retained earnings, which I'm really calling here growth. And so that would be into the new equipment, that would be into bringing on the new team member and expanding expenses a little bit more. So those are the 3 categories and the amount that you would put into each. Now, if you do have debt, then the goal would also be to get out of debt. So debt increases your overall risk of your business. Again, remember the 3 circles. We're in the danger zone if we're in the debt circle zone here. So before we get into that, again, we want to make sure we're always having our personal salary. We want to make sure we're not living off credit cards. We want to make sure that all of our business expenses are being covered, and we want to make sure our payroll is going out to our team. Okay. So we want to cover all those expenses. We have the revenue, we have our expenses, we want that profit. And then from the profit, what you would distribute is this. So again, you'd still have to put your money into, distribute some for taxes. Now, to get technical for a second, you can carry losses over from one year to the next. So if your business has a loss from the previous year, maybe you're not going to have to owe any taxes this year. So you can reroute those taxes to more debt if you talk to your CPA or whoever's doing your taxes and they tell you actually you're good, you still have losses that can carry. So that might be able to switch over into debt. If not, save for taxes, save for debt, and then you're going to have 20 going to that 3 to 6 months most likely savings account that's separate, and then you're going to have 20% that can go into growth initiatives. And that is how you would distribute your profits in that scenario. Okay, so just to recap, the best practices here is to keep your business and personal finances separate. Number two, pay what you owe when it's due. Try not to go overdue or try not to commit to anything if you can't afford it. The next thing is our profit principle. So we got to know our numbers, right? We got to spend less than what we make. We got to think like an investor. Everything has an ROI to it. And we want to prioritize the long term over the short term. Obviously, there's going to be a balance between both, between short term and long term. But typically, you want to edge maybe more towards, 70% of your dollars that you can invest into growth is more long-term focused, where 30% might be more short-term focused, just to give you a ratio there. And then some action items for you. If you haven't already done it, start making a budget, start understanding where your money's going and start getting some control over it. Number two, in the beginning, do your own accounting. Now, at a certain point, it makes more sense for your time to outsource that because your time's probably gonna be better spent in sales, marketing, working on your product, or refining your service. That's just realistic if you are the business owner. So I totally understand that. And you got to figure out for you two things. One, when there's enough demand, meaning the accounting is taking up a lot of your time, that's when you can consider outsourcing it. And two, you have the profits or you have the finances available to actually support those costs. Again, it's going back to you make sure you always want to pay what you owe. So you always have to have that cushion after your profits to then say, okay, is this now the time to bring on that accounting finance team member into my company? And again, you want to look at it from an ROI standpoint, look at it from an investor standpoint. All right. So then after that, you want to build your cash reserves and you want to get out of debt. So that wraps up the fundamentals of finance, how you can get a little bit more clarity, get a little bit more confidence, and understand how your finances play a role in your business. If you found this helpful, go ahead and drop a like and a comment down below on what questions you have or what you want to see next, or maybe explain in more detail. But that's all for this one. Thanks for enjoying, and I'll see you on the next one.